Sir.
Good afternoon, all. Is it audible?
Yes, yes.
Okay.
A warm good afternoon to all. Welcome and thank you for joining to our national webinar on the topic Union Budget 2021-22 and Evaluation. Before going to the session, let me introduce myself. I am Manju Maya, first year MBA student, Ahalia School of Management. Ahalia Group of Academic Institution is a part of Ahalia Health, Heritage and Knowledge Village. Palakkad is an initiative of Ahalia International Foundation headquartered in UAE. We are one of the biggest corporate group in Kerala with presence in healthcare, education, media and publishing, finance, alternative energy and successfully venturing into the other sectors too. Ours is the largest campus in Kerala, which is located in an exotic region of Palakkad at the foot of Western Ghats amid breathtaking valleys, verdant paddy fields and dense herbal garden, away from the din and bustle of the city life that is a perfect blend of nature and technology. Our Ahalia School of Management is a part of Ahalia Group of Institution with, with an ISO certified institution approved by AICTE and affiliated to the University of Calicut. Ahalia School of Management has proven to be one of the best management schools providing quality education to the students. Today we are dealing with the topic Union Budget 2021-22 and Evaluation. The session is handled by Mr. C.A. Ajit Shivadas, practicing chartered accountant. Before going to the session, let's begin with a prayer. I welcome Aranya and Hepzibah Isaac from Ahalia School of Management for the prayer.
അഖില ചരാചര രക്ഷകാ ദേവാ അകമഴിഞ്ഞങ്ങളെ പാലിക്ക ദേവാ അഴലാകി നീക്കി അങ്ങാനന്ദമേകി സകല സൗഭാഗ്യങ്ങളേകേണം നിത്യം അഴലാകെ നീക്കി അങ്ങാനന്ദമേകി സകല സൗഭാഗ്യങ്ങളേകേണം നിത്യം ക്രിസ്തുവും കൃഷ്ണനും അല്ലാഹു നീ സ്തുല സ്നേഹനിലയനും നീ സൃഷ്ടിയും രക്ഷയും സംഹാരമേവം ഇഷ്ടപതിശാനിൻ ലീലാവിശേഷം അഖില ചരാചര രക്ഷകാ ദേവാ അകമഴിഞ്ഞങ്ങളെ പാലിക്ക ദേവാ.
Thank you, Hepzibah and Aranya. Now, it's time to welcome Principal and Director of Ahalia School of Management, Dr. B. Vijay Chandran Pillai, sir. I heartily welcome you to this session, sir.
Okay, thank you.
Next, I would like to welcome President, Executive Director, EPP Rajadan, sir, to the session. Heartily welcome you to the session, sir. It's my pleasure to welcome our chief guest, Mr. C.A. Ajit Shivadas to the session. Welcome you, sir.
Thanks a lot.
Next, I welcome the coordinators of the program, Assistant Professor Jisha ma'am, Assistant Professor Dr. Ashna Siddiq ma'am, and all other faculty members of the Ahalia School of Management. Next, I welcome faculty member of other institutions who all are joined. Next, I would like to welcome research scholars, PG and UG students, and all other participants. Once again, I welcome all of you to the session. Now, I invite Principal and Director, Ahalia School of Management, Dr. B. Vijay Chandran Pillai, sir, for the presidential address.
A very warm good afternoon to all. Good afternoon. Esteemed resource person of today's webinar, CA Mr. Ajit Shivadas, practicing chartered accountants, my dear colleagues, faculty members from various colleges, research scholars, MBA students, MCOM students, UG students, and all others who have joined through online in this seminar. You know, today it is a very important day in the history of Ahalia School of Management. Why? Because we are conducting a very relevant function, that is national webinar on a very useful topic which is of current relevance, that is union budget, which is being very recently presented by our Honorable Central Finance Minister about the changes that have been taken place in the field of tax structure. So, why we are conducting these type of programs? You know, regularly students are getting from the classroom. However, a student will not be a full-fledged one in terms of knowledge unless they get some practical exposure. So how do we get practical exposure on a particular topic? Surely, program like these seminars and webinars play a very crucial role in imparting very relevant, very updated information about a particular topic among the students. Likewise, the students will get some special skills like skill to organize a program, then interactive skills, communication skills, then knowledge upgradation. So these are all the three or very important points which every candidate, every student can acquire by organizing or attending these type of programs. Surely, we are conducting a program based on a very relevant topic. Everybody is supposed to know about the tax structure, because as and when a person joins in an organization, everyone is supposed to know how much amount of tax he has to pay to the government if his income exceeds certain limits. That will vary according to the budget. You might have heard about the Finance Act. Every year at the end of last working day of February month, the Central Finance Minister will present the Finance Act. Do you know what is the reason behind this? The reason is the proverb, namely, change is the only unchanging law of nature. We have been witnessing very creative changes in various sectors of our economy. Finance sector, industrial sector, every sector, if you examine, you can see lot of changes. Definitely, these changes will have to be incorporated in the taxation structure. How do we incorporate these creative changes in the taxation structure without having a special regular act? That is why every year Finance Act is passed by the Parliament. Even though we are right now, even though we are strictly, we are following from the very beginning, that is from 1860s onwards, British rulers' law. The changes have been effected only through passing a Finance Act. So the act is very, very important. Everybody knows that the tax structure is contributed by the British rulers. In India, income tax was introduced in the year 1860. And 1866, the year in which the first Income Tax Act was passed in India. Then after the formation of the government of India, we have passed a new act considering the then existing situations in this tax structure in the year 1961. Since then, we have been following the same act with the certain amendments. In order to incorporate the amendments by means of creative changes in the field of finance and the tax structure, it is highly inevitable to pass Finance Act every year. Everybody should have a knowledge, thorough knowledge on the changes that have been incorporated in this act. So that is the purpose behind the organizing of a seminar like this. Really speaking, when I thought about the conduct of this program, I have discussed with my colleagues and I have suggested my intention to conduct a program like this. Definitely, I got very good support from my colleagues and my students. So at the outset, I take this opportunity to extend a very sincere appreciation and thanks to my fellow colleagues as well as students in organizing this program in a very wonderful and meticulous style. Now, we have got a very eminent personality to discuss with the very creative changes in the field of taxation as a result of Finance Act 2021. Hope that he will discuss every minute aspect in detail, which will be useful for the taxpayers. And I have one humble request before the participants that immediately after the presentation session, you have to interact. If you feel any queries, it is your humble duty to clarify the queries, because the resource person is very much interested in clarifying all the queries. He is a practicing chartered accountant. He is a tax practitioner, so that he will be able to clarify whatever query you feel in connection with the particular topic that he is going to present. So, with these few words, with the permission of all those who have joined through online, I formally declare that the inauguration of this webinar on Union Budget 21-22 is being carried out. And I wish all the very best, all the success. Thank you. Now I hand over to Manju.
Thank you, sir. Next, I would like to welcome Hepzibah Isaac, first year MBA student of Ahalia School of Management, to introduce the resource person, Ajit Shivadas, sir.
CA Ajit Shivadas, a practicing chartered accountant who considers costing as profession and teaching as passion in the field of practice for the last 7 years. Started a career as a practicing cost and management accountant, was a senior partner to the firm Ajit Shivadas and Company, later shifted the practice to chartered accountancy since inception of GST. Specializes in the area of cost consultancy and taxation related consultancy services, visiting faculty in all tax, finance and accounting subjects in various professional and management institutions. Renowned faculty in online classes platform, official trainer for managers in various public sector companies, runs offices at Palakkad, Cochin, Calicut and Nenmara under the same brand name, having 4 fully qualified associates and 15 semi-qualified assistants and 8 staffs in the team. And the office has a unique blend of chartered accountant, cost accountant, company secretary, related services under a common office umbrella. He completed his graduation in Bachelor of Commerce from Government College, Chittoor in the year 2008. He went on to do Associate Cost and Management Accountant in the year 2012 and Associate Chartered Accountant in 2013. He took Advanced Diploma in Management Accounting from CIMA UK Company Secretaryship Final. He has been working as practicing cost and management accountant at Palakkad for the last 7 years. He is the member Indirect Taxation and GST Committee in various national forums. He is a certified Indirect Taxes Auditor, Calicut Zone, professional faculty for the last past 6 years in various CA, CMA, CS chapters, MBA colleges and business schools, online tutor in CA Club India. He is an official trainer for various MNCs and public sector companies. He has presented seminars, symposiums, workshops on taxation, management accounting related topics in national and international platform. We welcome you, sir.
Thanks a lot for a warm welcome. A very good afternoon to you all. I first of all extend my sincere gratitude towards Principal and Director, Ahalia School of Management, Dr. Vijayendran Villasar, for inviting me to deliver a talk on the topic of the day, Union Budget. As rightly introduced by Villasar regarding the income tax law and various amendments year after year, soon after the inception in the year 1860, we have witnessed several amendments, several finance acts, several circulars, several notifications on this subject, income tax. So now, during this session, even though Union Budget would be having some other macroeconomic parts, we would be focusing more on the taxation perspectives. We would be brushing upon some of those major macroeconomic reforms proposed by Honorable Union Finance Minister Nirmala Sitharamanji. But our main focus would be on taxation aspects as well as some of those amendments which has been brought in regarding corporate matters, company law matters. So with all your kind permission, let me start the session. Hope I am audible, and the PowerPoint that I am going to present is visible to you all. Is the PowerPoint visible?
Yes, visible.
Hello?
Yes, visible.
Thank you. So Union Budget 2021-22, the budget presented by Honorable Finance Minister in the Parliament on 1st of February 2021. The peculiarity, the speciality of this budget is, this is the budget presented by the Finance Minister after novel coronavirus era or post COVID-19, the first budget. And this is also the first budget for the decade. And also, in the history of India, this would be remarked as first paperless budget. So these are all the peculiar features of this historic budget, Finance Budget 2021. And during the presentation of this budget, the Finance Minister focused on 6 pillars. 6 pillars being health and well-being. Second one, physical and financial capital as well as infrastructure. The next focus was on inclusive development for aspirational India, another slogan, aspirational India. Reinvigorating human capital. Fifth one being innovation and research and development. The last and final pillar being minimum government with maximum governance. And throughout her budget speech, Finance Minister focused on the term Atma Nirbharata. So the entire theme of subject is being focused on that key terminology, Atma Nirbharata. And as I rightly mentioned, this to be the budget after COVID-19, not after COVID-19, but that lockdown period, that quarantine period and all. So the number of amendments that was ought to have been usually in budget may not be there. In other words, there were lot of amendments during those finance budgets, whereas during the current finance budget, maybe due to this scenario, the amendments are only a handful. So during this session, as I rightly mentioned earlier, we shall be going on through various macroeconomic aspects, but our main intention would be to go through taxation perspectives, that too direct taxation perspectives. During the budget, there were certain things that has been given to Kerala, and a couple of them being Madurai-Kollam corridor as well as Mumbai-Kanyakumari corridor. So for infrastructure development, for developing national highways, 65,000 crores has been allotted. That's one among the benefits for the state of Kerala. And how is the national income, how the rupee comes, how the rupee is being expended, could be mentioned in every budget that belongs to Part A. Part B is relating to taxation aspects, whereas Part A, the government, the cabinet, the union finance minister would be explaining how they are going to earn income, how they are going to get expended. So the source of fund as well as the application of funds would be mentioned. So for the financial year, a single rupee goes out towards interest payment at the rate of 20%, and the central government have to give the total revenue shares to other state governments as well as union territories, and 16% of total rupee would be allocated, devoted towards state government share. Then there are various central government schemes. So in order to meet those expenditure, capital as well as revenue expenditure for sponsoring central sector schemes, 14% has been allotted. For finance commission and other transfer, 10%. Miscellaneous expenditure, 10%. For subsidies and all, 8%. For defense, 8%. For pension, 5%. This is how a rupee is being expended. And now the question comes, from where do a single rupee come? If you take the borrowings in order to meet such expenditure as been mentioned above, in order to meet such expenditure, out of a single rupee, 36 paise or 36% of a total rupee is out of borrowings, by going for bonds option, by borrowing from international banks and all. The government arranges the fund, and the lion part of other revenue income is out of taxation, wherein after introducing GST had become one among the major sources for government to raise the revenue. And out of the total revenue, almost 15% is out of GST, 14% from income tax, and corporate taxation perspective 13%. Even after introduction of this GST on certain petroleum products and all, union excise duty still continue to get exist. So union excise duty 8%, non-tax revenue in other forms 6%, non-debt capital, other than debt, government would be introducing capitals also, out of which 5% is being contributed. And finally, import-export duty, customs duty, it's at the rate of 3%. So this is how the nation earns an income, and in the previous slide we were mentioning how it is being spent with. After having that macro view, let us move on to discuss with various income tax amendments proposed during the budget. We know this finance budget 2021 is for the financial year starting from 1st of April 2021 ending on 31st of March 2022. Previous year would be 2021-22, and the assessment year would be 22-23. For this current previous year, that is financial year 2020-21, the current assessment year would be 21-22. Those taxes, those law would be on the basis of amendments which was being proposed during finance budget 2020. As commerce students, as MBA qualified students or pursuing students, definitely you would be knowing all these basic aspects. But just to reaffirm that concept, I am to recommend on the same. This finance budget 2021 is for the previous year 2021-22, applicable for assessment year 22-23. So what are all those amendments? First among the favorable amendment being, there is a relaxation given to senior citizens. As per income tax provision, senior citizen means a person who is having age over and above 60 years. But this exemption, this relaxation is not eligible for all senior citizens, but it would be getting applied only for those senior citizens who have completed 75 years of age. So for those senior citizens who have completed 75 years of age, there is a relaxation to submit income tax return. So any senior citizen who is having 75 years of age subject to the conditions listed below, are not required to file income tax return. So what are all the conditions that has to be followed in order to get relaxed from income tax return, submission of income tax return? If we ask, the answer is, there is a section inserted during the current finance bill, section 194P. Section 194P is a tedious section wherein the banker have to deduct the income tax after getting the declaration from 75 years and above senior citizen. So how a senior citizen having 75 years and above can avail this benefit? The senior citizen have to approach specified bank. So who are all the banks who are specified in order to make this exemption available would be listed sooner by the ministry. If our bank is mentioned in that specified banker list, then the such senior citizen have to approach that bank and have to declare the pension income as well as interest income. And out of such income, the total tax due would be calculated by the bank and it would be deducted under section 194P. All the deductions under section 80C to 80U, that is chapter 6A, all the rebate under section 87A, all would be duly given by such agency. And after computing all those deductions or after getting all those relaxations or those exemptions given, and the net tax amount would be deducted under section 194P. So if the bank gets that declaration from such a senior citizen and they are having only income from pension and bank interest sources, then the bank deducts the TDS under section 194P. Then only the senior citizen who is over and above age of 75 can avail this exemption, that is not to submit income tax return. The people would have a myth that all senior citizens who are over and above 75 age is exempted to file the income tax return. The reality is not that a relaxation. Rather, those senior citizens having age more than 75 years, subject to these conditions, only income should be pension income as well as interest income. They have to submit a declaration before the specified bank. The bank list would be published soon, and such bank, after going through all the income of such senior citizen, after giving deductions under chapter 6A, after getting 87A relief, they would be deducting tax under section 194P. So subject to all these sections, a senior citizen is not required to file income tax return. In other words, there is a relaxation for them. So this is the first among those amendments. Second one being, there are a lot of schemes proposed by the present government, one among the same being Startup India. Startup India initiative, lot of exemptions has been given. So in taxation perspectives also, a lot of deductions, lots of exemptions has been given to those newly startup entities. And those exemptions were there only up to 31st of March 2021. So the startups were ought to have been receiving such tax incentives only up to end of this year's March, that is 31st of March 2021. But after amending that provision, the startups would be getting that tax holiday for another single year. In other words, they would be eligible to get tax holidays up to 31st of March 2022. Another favorable amendment for those startups, those business concerns. Third one being reduction in time for income tax proceedings. Earlier, the income tax officers do had an option to reopen closed cases for previous 8 years. Under section 148 of the Act, there is a provision, income escapement assessment, section 147 as well as section 148, dealing with income tax escapement assessments, income escapement assessments. So if an assessing officer has some doubts regarding an assessee regarding whether such income have been escaped during the assessments, after getting permission from joint commissioners, deputy commissioners, they can reopen the cases up to the last 8 years. But that limit of 8 years has been cut short to 3 years. So now the officers can reopen those cases only for the past 3 years. But only in case of highly fraudulent cases, then only after prior permission from authorities, the assessing officer can reopen the case over and above these 3 years. So in short, almost all assessments would be reopened only for 3 years against earlier 7 or 8 years. 6 years was there, 2 years again can be given back. So in short, 8 years would have to be kept by the assessees during the previous tenure. But after amending such a reduction in time for IT proceedings, now there would be reopening only for 3 years. Then regarding salaried persons, salaried assessees, there is an amendment regarding leave travel concession. Employees can avail exemption for leave travel concession on 1/3 of such expenditure or 36,000 rupees, whichever is lower, for this block 2018-21, if during that period the expenditure, the specified period being October 12th, 2020 to 31st of March 2021. So if during the period any leave travel allowances or concessions has been availed by the employees, and such expenses out of which they have incurred GST at the rate of 12%. So if they have undergone any travel, and during the tenure if they have purchased any goods or services availed by paying GST at the rate of 12% or more, in non-cash mode, that is debit card, credit card, or RTGS, NEFT, UPI, etc., non-cash form if they have incurred during this period, October 12, 2020 to March 31st, 2021, they can avail a deduction, that is 36,000 rupees or 1/3 of such expenditure, whichever is lower. So it's a benefit for employees to have availed this leave travel concession during the mean period. Another amendment regarding dividend income. We know during the previous budget 2020, section 115(o), dividend distribution tax has been scrapped. So earlier, if the company have paid a dividend distribution tax at the time of declaration or payment of dividend, then the receiver, that is the shareholder, was not required to pay tax on such dividend income for the reason it has been already taxed in the hands of company. But after scrapping that dividend distribution tax, now that classical income tax theory comes back, it would be again back taxed in the hands of shareholder. And during this financial year, if such income would have been received, such income was liable to get attracted by advance tax provisions also. But here, after this amendment, advance tax on such income would be applicable only after declaration of such dividend income. That is, suppose dividend is declared for the month or in the month December 2021, there were 2 prior advance tax payment date being June 15th and September 15th. So under earlier provisions, advance tax interest 234B as well as 234C would have been attracted if such advance tax was not being paid during the earlier 2 quarters. But now after making the amendment for such provision, the advance tax on such dividend income is only required to be paid after declaration of such dividends. Then there are certain tax holidays proposed for aircraft leasing as well as rental companies. Then pre-filing of returns to be for front. Now if we go through income tax website, ITR1 simple return can be filed easily by the taxpayer. We have to have that login ID as well as password. Login ID is nothing but our PAN. We have to register in income tax site. After registering in income tax site, using that password, we can log in, and there is a option to e-file the return. ITR1 was already pre-filled. Pre-filled in the sense all the income such as salary, interest from interest from banks, dividend income, etc., which it reflects in 26 years would be pre-filled. Our bank account details, Aadhaar details, PAN number, everything would have been pre-filled in that return. Now that ITR1 and ITR4 are only the pre-filled returns. Now the government is trying to extend that initiatives to other returns also. So pre-filling of return would be beneficial for the assessees. They need not go to the tax officers or they did not approach tax consultants in order to file the return, they can self-file the return, and they can also save such fees that have to be paid for such tax consultants. So pre-filing of return has been made more prominent, or a number of forms under which pre-filing is eligible has been extended. Then if we have not filed the income tax return, then there is a higher amount of TDS. The rate of TDS would be at 5%. So that section 206 AB has been inserted. In other words, for those non-income tax filers, there would be another TDS under section 206 AB, wherein the rate would be at 5% or twice the rate which is being enforced in any other income tax deduction sections, TDS sections. Then disallowance of PF contribution. In case wherein the employer, being a business entity, have deducted the employee provident fund contribution but has not remitted the same towards the exchequer, has not been paid to that employee provident fund trust, such amount which has been deducted but has not been paid within the due date for filing the return, within the due date for paying such amount, would be disallowed. In other words, such expenses cannot be allowed as expenditure. It cannot be deducted while computing that head of income, profits and gains from business and profession. So that section is making the employer assured that, or the employee assured that, all the amount which has been deducted by the employer is duly deposited in their respective PF accounts. So welcome, we will move 8th one. 9th one, another section 80EEA. Section 80EEA is an extra deduction eligible for those persons who have availed home loan, and that section 80EEA was applicable only up to 31st of March 2021. Now that eligibility has been extended to another year, that is up to 31st of March 2022, they can avail that benefit. So what is the benefit under this section 80EEA? If we inquire, the benefit is the deduction, extra deduction eligible for the interest paid on home loan, affordable homes. If we have availed home loan up to 35 lakh, having the total cost of house being limited to 45 lakhs, over and above the interest deduction under section 24B. We know section 24B for income from house property. For self-occupied property, there is a limit of 2 lakh rupees, or actual amount whichever is lower. For let-out property, there is no limit of deducting the interest. But for residential self-occupied properties, definitely there is a slab of 2 lakh rupees. So for those persons who have availed the loan and having interest over and above 2 lakh, they cannot deduct that amount of interest against any other income. But this section 80EEA allows them to have another extra deduction of 1,50,000 rupees. But it is not a double deduction. Double deduction in the sense, suppose the total interest is 1,80,000 and that 1,80,000 has been already availed under section 24B. You are not allowed to get deducted again under this section 80EEA. But if your total interest is over and above 2 lakh rupees, you are being limited under 24B to be as 2 lakh rupees. Suppose you are paying interest on 3.2 lakh during the previous year, 2 lakh you can avail it under section 24B. Over and above 2 lakh, 1,20,000 you can avail it under section 80EEA. So the amendment occurred is this section 80EEA, interest on home loan 1.5 lakh extra deduction was being eligible only for those home loans taken up to 31st of March 2021. Now it has been extended to another year. That is the home loan availed up to 31st of March 2022. We can avail this deduction, extra deduction of 1.5 lakh under this section 80EEA. Then a relief for NRIs, non-resident Indians. There is a section inserted 89A. It actually provides double taxation. Double taxation in case where any NRIs who after finishing their employment, after finishing their job, if they are retiring from their job, respective jobs there, they are coming back to India. Now under the existing law, there is a scope for double taxation. Any income earned there was being again asked to be paid here at India also. So there would be two taxation on the same income. So in order to help those NRIs from that genuine hardship, this section 89A has been inserted, and thereby a relief from double taxation due to mismatch of taxation of income from withdrawal of retirement benefit account maintained by a specified person in a notified country on account of amount being taxable in the notified state on receipt basis while being taxable in India on accrual basis has been shifted. So now there won't be two taxes in case of individuals who are having retirement benefits from that country. It won't be taxed twice by applying this relief under section 89A. Then a new section, a TDS section has been inserted, 194Q. This is applicable for all persons, including all laymen. Here, any person who is paying any sum over and above rupees 50 lakh by purchasing any goods. So suppose I am purchasing any goods worth rupees 50 lakh and above. On such purchase of goods, if the total value of goods during the period is more than 50 lakh from a single person, then I would be required to deduct the TDS at the rate of 0.1%. Suppose I am purchasing a movable property in form of car. In any other movable property, suppose I am purchasing. Now there is a section wherein I have to deduct the tax at the rate of 1% if I am purchasing an immovable property. But that immovable property at the rate of 1% is required to get deducted if I am purchasing any land, building, etc. Now it has been extended to movable properties also, but at a lower rate, the rate being 0.1%. So this is the new section which has been inserted. So by inserting this section 194Q, any layman, any person who is purchasing any movable property over and above 50 lakh would be required to deduct 0.1%. The remaining 99.9% has to be 99% has to be given to the actual person, and the remaining would have to be deposited in income tax account. That's how it has been inserted, section 194Q. Then, regarding PGBP heads, a section 32, we know, the section for depreciation. So till this amendment, the total assets were being classified into two: block A, tangible assets, as well as block B, intangible assets. And for intangible assets, there was a depreciation, or there is a depreciation at the rate of 25%. And such intangible assets include goodwill also. Goodwill, patent, copyright, etc. Intangible assets. But now by this amendment under section 32, intangible assets has been excluded with this term goodwill. In other words, any goodwill appearing in the books of accounts would not be eligible to get depreciation under section 32. That's how it has been amended. So in short, any goodwill which is appearing in the books of accounts, may it be purchased goodwill, may it also be self-generated goodwill. Both for self-generated as well as purchased goodwill, there won't be deduction under section 32 at all after this amendment for section 32. Hope it is clear. Then, regarding tax audit under section 44AB, we know under section 44AB, there are certain categories of business entities who are required to get audited their books of accounts by a qualified chartered accountant. Any associates who is having, or business entities who is having turnover over and above 1 crore during the previous year, in case of profession 50 lakh rupees, or in case wherein the total income declared by such assessee is less than that of 44AD, 44ADA, 44AE presumptive taxation sections, then it has to be audited. They have to maintain books of accounts under section 44AA. We know during the previous finance bill that 44AB limit has been extended to those persons who are having turnover up to 5 crores, provided that those assessees who are having turnover up to 5 crore need not get their books of accounts audited by a chartered accountant, provided that out of their total receipts and out of their total payments, less than 5% would have been through cash mode. In other words, more than 95% of total receipts and more than 95% of total payments at least must be in non-cash format, that is in RTGS, NEFT, debit card, credit card, UPI, BHIM, Aadhaar, etc. If they have carried out such receipts and the payments, then if their turnover is less than 5 crore, they need not conduct tax audit at all. But now, during this finance budget, that 5 crore limit has been further extended to 10 crore rupees. That is, any assessee who is having turnover up to 10 crore, subject to the condition that if their total receipts, 95% at least is out of non-cash form, their payments also 95% is in form of non-cash format, then they can avail this benefit. They need not have to undergo their books of accounts audited by a qualified chartered accountant. Rather, this section 44AB is not applicable on such cases. So definitely for sure, the government is aiming to make the wholesome transactions to be under these electronic forms only. They are trying to discourage all those forms of cash sort of transactions. We know in this head, the PGPP, lot of cash related restrictions are there. Section 40A3 is there, which restricts any payment less than more than 10,000 should have been carried out under any other non-cash format, account pay, grocery check, RTGS, NEFT, etc. We know that section 32 restricts depreciation for purchase of capital asset over and above 10,000 to be under cash forms. We know section 269 SS is there, 269T is there. No one is allowed to accept cash loans. No one is allowed to pay cash loans over and above 20,000 to a single person during a single year. Then 269 ST is there, which is a cap for any payment over and above 2 lakh should not be made in cash. So a lot of cash related restrictions are there. So simply, generally and slowly, the government is trying to reduce the cash inflow, the total cash payments and the total cash flows in the system, and they are trying to convert the same towards electronic format of payments as well as receipts. They are promoting the same. So in order to do the same, this step has been taken, 44AB, that it has been extended further for 10 crore for those persons who are promoting the digital payments. Then this section 44ADA. This section 44ADA is a section which is for those specified professionals in the area of accountancy, architect, interior, decoration, medicine, legal, company secretaryship, etc., etc., etc. So those persons who were having the turnover, the total receipts during the period less than 50 lakh, they had the option to go for this route 44ADA. They need not maintain books of accounts under section 44AA if they declare a profit under this 44ADA to be 50% of total receipts. Suppose myself to be a chartered accountant and I am having an income, a total receipt during the period, suppose 30 lakh rupees. If I go for this option 44ADA, 30 lakhs, 50%, 15 lakh rupees blanketly I have offer it to be as my income. There is no requirement to file the profit and loss account as well as balance sheet. There is no requirement to maintain books of accounts under section 44AA. So instead, if I am declaring it under section 44ADA, I would be simply required to file the income tax return by declaring 50% of my total receipt to be my income. So post this amendment, before this amendment, this eligibility 44ADA was applicable to all persons in the sense, may you be a professional in case of individual status, HUF status, partnership status, also in status of LLP company, whatever status it is, you would be or we would be eligible to get this benefit 44ADA presumptive taxation. But after amending this section 44ADA, this beneficial submission of income tax return, that is by declaring 50% would be eligible only for individual, only for this partnership and HUF sort of entities. So remaining all types of assessees, may it be an LLP, may it be a company, any other form of other entityships other than individual, HUF as well as partnership firm, we cannot avail this benefit under section presumptive taxation benefit under section 44ADA. So in case of my example, suppose my chartered accountancy firm is an LLP, and till the previous year we had that privilege to go for this 44ADA presumptive taxation. But after this amendment, from next year onwards, an LLP entity cannot avail this benefit under section 44ADA, that is 50% of total receipt to be declared as income in case wherein the total receipt is less than 50 lakh during the period. Then another amendment regarding the due date for filing returns, the due date for revising the returns. We know section 139 of the Act provides for various provisions regarding submission of income tax returns. So regarding the time limit for submitting income tax returns, there are 3 due dates. Due date for tax audit cases, due date for international transaction related 92E cases, due date for non-tax audit, non-international transaction due dates cases. For non-tax audit, non-international transaction related cases, the due date before which the return has to be submitted would be 31st of July following the previous year. That is, for the previous year 2021, the last date for filing income tax return is, or the due date for filing income tax return is 31st of July 2021. For tax audit cases, it would be extended to 31st of October 2021. In case of any persons who are indulging in international transactions and wherein any certificate from a qualified accountant has to be received and have to file the return under 92E, the due date for them would be 30th of November 2021. And after that due date also, there would be some date given in order to file belated return. Belated return means any return which is filed after the actual due date. So for this assessment year, for the current financial year, that is for financial year 2021, for the relevant assessment year 21-22, after these 3 due dates, may it be 31st of July, may it be 31st of October, may it be 30th of November, after these due dates also, these assessees can file the return up to 31st of March 2022. That is, they can file belated return. And also during this mean period, if any errors crept in, any unintentional errors crept in, the assessees would be having that opportunity to revise the return also. They would be having that privilege to alter the return, amend the return, revise the return. Till 31st of March 2022, they would be getting that opportunity to file a belated return, or previously filed return, they would be having that benefit. They would be having that advantage to revise also. But that extended belated return or the period for revising the return has been cut short till 31st of December of the current year itself. In other words, we cannot file a belated return, we cannot revise a return from 9 months from the date of end of relevant previous year. That is, if this section gets amended, if we are taking, for example, this financial year 2021 into consideration, you asked to file the return before due date, that is 31st of July, that is 30th of November or 31st of October, in case of all those specific type of assessees, you would be having that privilege to file up to 31st of March 2022 has been cut short to 31st of December 2021 itself. So 3 months we are actually losing. For that 3 months, we are not allowed to file the return, not for 3 months. After that 31st of December for the current financial year, or after 9 months from the last date of current financial year 2021, if you take 31st of March 2021 would be the last date of that financial year. 9 months means 31st of December 2021, after which you are not allowed to file the return, nor we would be losing the option to revise the return also. So in short, the time limit for filing returns has been cut short for 3 months. That's how this would be getting effective. That is section 139(4), that is for filing belated return. Section 139(5) for filing revised return has been amended. Then there are certain changes as far as Companies Act also concerned during the Honorable Finance Minister's 2021 budget. One among the same being redefinition of small company. Under the current provisions, before amendment, a small company has been defined as a company having total paid up share capital less than 50 lakh and the total turnover during the immediate preceding financial year is less than 2 crore. So in case of small companies, if they are having any capital less than 50 lakh paid up share capital, or if they are having their total turnover for the relevant previous year being less than 2 crore rupees, then only they would be classified as small company during the prior budget scenario, and only those small companies were relaxed from lot of compliances which ought to have been followed by other companies. So a lot of relaxations are there, a lot of benefits are there for small companies for the company related provisions. But it was being limited for 50 lakh paid up capital as well as 2 crore turnover limited company. But now that limit of 50 lakh paid up capital has been extended, has been raised to 2 crore rupees, as well as that threshold limit of 2 crore for turnover has been enhanced up to 20 crore rupees. So in other words, small company have been redefined to be as a company having paid up share capital 2 crore or less, and also the turnover being less than how much? 20 crore rupees. So via amending this 50 lakh to be 2 crore and 2 crore to be 20 crore, almost 2 lakh companies in India would be getting benefited. In other words, another 2 lakh company would be having that compliance related relaxations, company law related benefits. Another 2 lakh company would be enjoying. That's how this relaxation has been given. So in short, small company definition has been redefined. 50 lakh paid up share capital extended to 2 crore. 2 crore turnover criteria extended to 20 crore. Another amendment in case of one person company. We know earlier, or 3 or 4 years back, we cannot assume a company to be having carried out by a single person. At least 2 shareholders should be there, at least 2 directors should be there, was the position. But after that radical shift in that concept of company, a single person can himself declare to be as a company, and that terminology is one person company, and it is actually that concept is taking forward, and a lot of entities, lot of entrepreneurs are coming forward to have that corporate status as OPC. And to a boost to that initiative, lot of benefits has been given to such one person company entities also during the proposed finance bill. And as far as the current post or pre-budget scenario is concerned, a one-person company can only be incorporated by a natural person who is an Indian citizen. So only Indian citizens were eligible to incorporate an OPC earlier, after or before this budget, and after this budget also a non-resident can apply for one-person company. So earlier, a person who has stayed in India for 182 days would be classified as a resident, but after amending in Union Budget 2020, that 182 days has been shortened to 120 days. So any person who has stayed in India for a period of not less than 120 days during the immediate financial year would be treated as a resident. But here non-resident also can go for OPC option, and there were certain restrictions for OPC regarding turnover as well as their capital. OPC cannot be opened or OPC cannot be extended if the total capital becomes 50 lakh and more, if the total turnover becomes 2 crore and more. So there was some restrictions relating capital as well as turnover. Now there is no restrictions regarding capital, regarding the years of inception, regarding the turnover criteria. N number of capital can be there, N volume of turnover can be there, irrespective of actual capital, irrespective of actual turnover. OPC can get extended their services, they can do their business. So earlier, a one-person company would be automatically converted to a private limited company, and during that conversion, they would be required to follow all those provisions regarding the earlier Company Act provisions. But now all those restrictions has been done and dusted, so that a one-person company would not be automatically converted to a private company, even though their total turnover, even though their total paid up capital during the period surpasses those limits. So these are all the various provisions regarding the changes in company related provisions. Now after this tax related amendment related provisions, let me have a brief with regarding to the various rates prevailing for individuals as well as corporate assessees. As I mentioned at the starting of the session itself, there are no much changes regarding rates are concerned, or if you take any recent budgets for the last 10 or 15 years, this budget witnessed the shortest or the smallest number of amendments. Why? Because maybe due to the reason that the country or the world is recovering from that corona crisis, maybe to make the people not that much affected with this haphazard amendments and all. So no that much of explicit amendments can be seen, either relaxation purview nor as purview of any restrictions. Lot of amendments were being there till the previous budget, but this budget witnessed only small number of changes in those rates, those tax computations, etc. But it would be noteworthy to refresh back what were those declarations during the finance budget 2020. If we go through, during the finance budget 2020, that finance act which would be applicable for the relevant assessment year 21-22, the next year for which we are going to file the return, this year's income, 2021's income, if we go through, we do have got two options: old regime option as well as new regime option. Old regime option, after availing all those deductions, after availing all those exemptions and all, we can go for the old rate of tax, that is up to 2.5 lakh there is no tax, up to 2.5 to 5 lakh 5% tax, 5 lakh to 10 lakh 20% tax, 10 lakh and above there is a tax of 30%. But if we waive, if we sacrifice all those deductions, if we doesn't avail those deductions and benefits, then there would be another slab rate for a new tax regime they used to call. Under that new tax regime, there is reduction in rate of tax under section 115 DAC. So all those rates for individuals would be keeping on without any amendment. So there is not at all any change as far as rates of concerned is, as far as individuals are concerned. Over and above this taxes, there would be a education cess at the rate of 4%, and there would be surcharges also. And for corporates, if we take, there are 4 types of taxes for corporates. There is a tax 15% for newly manufacturing concerns. There is a tax at the rate 22% flat for manufacturing concerns who are waiving of certain deductions, additional depreciations, etc. There is a tax rate at the rate of 25% also for corporates. There is another rate which who are not following this 15, 22 and 25, they would be taxed again at 30%. This is how corporates are being taxed. So the same rate of taxes along with cesses and surcharges would be applicable for the corporates also. And there is no change for cooperative societies. There is no change for AOP, BOI. There is no change for taxes of partnership firms also. So all those rates, all those process of taxation, everything would be going in that way itself. And if we take in case of trust, in case of education institutions, there is a section 1023C we used to call. Under section 1023C, before amendment, any schools, hospitals, education institutions, universities who are having turnover up to 1 crore were eligible to get a blanket exemption. That exemption has been now extended to 5 crore rupees. So in other words, if we are having, or if we are an education institution, if we are in a hospital or any other management institutions, then that section 23 AC limit has been enhanced to 5 crore. So blanket exemption is there for education as well as hospitals, education institutions as well as hospitals. And certain amendments are there as far as charitable trusts are concerned. Lot of restrictions has been imposed on charitable institutions despite of these situations. So these are all a broader view with regarding to the total budget for the financial year 21-22. That is finance budget 2021. That's all from my side, and I have been allotted with 50 minutes, and the remaining 10 minutes I do hope that there would be some queries from the audience part, and I do invite any query regarding the budget or any other things regarding taxation. Please feel free to ask. As mentioned by Pillai sir, actually you are welcome. Only by your interaction this session can be made to be a success. So I kindly request all to have any doubts, definitely ask. Please don't have any shy. Please. Thank you. The door is open to you all. Hello, sir.
Okay. Please. Okay, thank you, CA Ajit, for your nice presentation, incorporating all the relevant amendments which took place in the 2021-22 Finance Act.
Please,
So,
thank you.
right now it is a time of interaction. I hope that participants may have some queries to clarify. Please, anyone intends to ask any query, please. I have already pointed out that he is a practicing chartered accountant. So, he can clarify all of your queries.
Revati has raised her hands. Revati has raised her hands.
Ajit, there is one question in the chat box.
Yes, actually, one Sri Kumar. Sri Kumar has asked me regarding that limit of FDI, foreign direct investments in case of insurance sector. Yes, there is. The Union Finance Minister have proposed for privatization. They have extended the foreign direct investment limit from 49% to 74%. Then also there are some proposals regarding privatization of 2 banks also. So in such case, definitely this question is relevant. So after this foreign direct investment to be there, definitely the government is losing their stake. They would be losing their control over and above. So if there is any chance of increasing premium, if we ask, actually it's their policy matter, but there is a chance. Definitely there is a chance that there can be some increase in premiums. But that foreign direct investments need not be that much worried with, I do personally feel, but because it's the need of our to have some liquidity for us, it would be better to have some foreign direct investments. But our stake, our sort of comfort should not be sacrificed for the same. Actually, Srivas sir, definitely our concern is on the mark only, but we can hope that it won't happen. Let us hope so. Yes, sir. LIC IPO is also on the way. So actually, it's an criticism over the present government that they are trying to privatize the sector, but it's actually a government policy. It may be a welcomeable, we don't know. We have to wait and watch how it actually goes through. But it's definitely for sure, it's an area of concern. That's my personal sort of review, right?
Okay, one Revati raised one query.
Sir.
Revati, please raise your query. Please, Revati. Revati, please raise your query, please. Revati, you can on your video and you can speak, please. Then another query is raised by Riji MK Rajan. Riji,
Yes.
Please on your video, please you speak.
Kindly to unmute yourself, please.
Riji K Rajan.
I do think that there are some technical issues there on their side.
Some connectivity problem may be there. That is why.
Maybe, sir. Maybe, sir.
Ajit, could you please explain
Sir,
Yes, Reggie is online. Okay, Reggie, please on your video, please.
Sir, I raised my hand by mistake.
okay, no issue,
Don't
madam.
worry. Okay, please. Ajit, please, you explain any changes in section 80C because it will be useful for many taxpayers. Is there
Yes, sir.
any change in section 80C, number of items as well as the rate of maximum ceiling which is applicable under section 80C?
No, sir, it has not been enhanced, sir. It has been still
No change.
sealed. It is still sealed under section 80CCE only. That is
Okay.
1.5 lakh. 80C plus 80CCC plus 80CCD1 National Pension Scheme. It would be sealed to 1.5 lakh only. But over and above that amount, definitely for sure that 80CCD 1B is there, 50,000 extra deduction. Then 80CCD 2 is also there, sir, on employer contribution. Apart from which, there is no explicit increase in that deduction limit. No limit.
Okay.
So there is a question.
Any more
Sir,
queries, please?
Sir, actually, I do think that actually myself being a CA student in my back days, this budget would have been very much appreciated by CA CMA students. I do hope. Why? Because only a few handful of amendments are only there. Otherwise, we as students would have to go through all those amendments, but this would be welcomed by all the students, I do think. Why? Because only a small number of amendments are there. No beneficial amendments, nor restrictive amendments. If we evaluate this 2020.
Okay. Deepthi K has raised one query. Deepthi, please on your video. Deepthi K. Deepthi. Deepthi raised one question. Deepthi. Network issue. She has some network issue. Ajit, the question asked by Deepthi is, which company's IPO will be launched in 2021-22 as part of government's disinvestment strategy?
Yes, sir. Actually, the thing is, I do think that actually, as rightly mentioned by Srikumar sir also, LIC may be the first one, but now the latest news comes that that amount has been reserved to 10% only. This is as per the media only. So as per that view, 10% would be the reserve. After that reserve, definitely the government would be trying to de-invest the LIC upfront. Then definitely these two banks are also undergoing this privatization. Indian Overseas Bank, I do think, one among the same. So all these things would be happening in the immediate future, I do hope. That's how it is going to get.
Okay.
So please comment on saying that salaried persons are disadvantaged when comparing to businessmen. Yes, exactly, Rajitan sir. The thing is, the employee class being, so for the reason that I am in the field for the last 12 years, including my articleship days, if we go through the assessee part, definitely all those salaried persons are getting all their income through wide sources only. Wide sources in the sense, through proper channels only. The employers, may it be government employer, may be non-government employees, definitely they are required to deduct the TDS and all the amount they have earned, maybe through salary means, maybe through interest on say fixed deposits, maybe through share market, etc. All the things would be directly exhibited in our 26 AS form. So definitely there is no other way for salaried persons to hide their income at all. First and foremost one. Second one, the amount of deductions, the amount of expenditures that can be deducted by the salaried persons is also a few. That is only section number 16 provides for deduction, and under section 16 there are only two avenues. That is professional tax we can deduct, and another standard deduction is there for 50,000 rupees. Apart from these two, there are no other deductions at all. Then only in case of government employees who is getting entertainment allowance, another small deduction is there. So keeping apart these three deductions, the number of deductions eligible for a salaried employee is very less. Then also any expenditure even for traveling for going to office, coming back, going to employment place and coming back is also cannot be deducted. Any interest cannot be deducted. No other expenditures can be deducted. So definitely for sure, salary being one among the head for which expenses are not there. And as I likely mentioned earlier, everything is under the proper channel only. But that business person would be definitely having that leverage to inflate their expenses or to deflate their income. But anyway, the government would be definitely trying to sort out their issues also. Definitely we can expect some more benefits for salaried persons also during the next budgets. Definitely we can hope for that, sir.
Participants, any more queries from your side, please? Any more queries? This is a right opportunity to ask your queries. Ajit, nobody has query.
Okay. I do hope that, sir, there are two chances that they may have got a clarity regarding what are all the amendments which has been happening during the year's budget. Let us hope so, sir. Anything they can actually ask after this session also, if any opportunity is given for them.
Any more queries? Any more queries? Any more queries, please? Any more query about even salaried? Yes, Rashmi wants to clarify. Rashmi, hope that Rashmi wants to clarify any query, please. No query. Okay. Then okay. Shall be wound up. Okay, no problem. We can conclude. Okay, now, okay, thank you. Over to Manju. Now over to Manju.
Thank you, sir.
Okay.
It really was a nice session. And now let's move to the final session. I invite Divya Mary Thomas, first year MBA student, for the official vote of thanks.
A warm good evening to one and all gathered here. It's a matter of pride for me that I am proposing vote of thanks for today's meeting. I, on behalf of my college and entire team, first of all spread my most sincere thanks to God Almighty. I would like to thank our chief guest, CA Ajit Shivadas, practicing chartered accountant, who gave us his vital time from his busy schedule to grace this meeting. Thank you, sir. Further, I would like to extend my sincere gratitude to Professor Dr. B. Vijaychandran Pilla sir, Principal and Director of Ahalia School of Management, for his esteemed presence and valuable support. Thank you, sir. Also, I would like to extend a hearty vote of thanks to Mr. E.P.B. Regidan sir, Executive Director, Ahalia Group of Academic Institution, for all the support and guidance he has given us. Thank you, sir. Next, I would like to thank our coordinators, Assistant Professor Jisha ma'am, Assistant Professor Ashna ma'am, and all the faculty members and non-teaching staffs of Ahalia School of Management. We are fortunate to have a dedicated and well-motivated team who are aware of their tasks and are very concerned about the results. Thank you. Further, I mention my sense of gratitude to the faculties of various other institutions and research scholars for taking their time to attend this event and for making it a successful one. Thank you. Last but not the least, let me thank all the students and other participants who are assembled here in this online platform to participate in this meeting. Thank you all. Once again, I thank each and everyone for making this event a successful one. It has remained a pronounced pleasure. Have a great evening.
Thank you, Divya, and thank you all for the patient listening. Now let's conclude the session by a national anthem. I would call upon Ahalia and Hetsiba for the national anthem.
जनगण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल बंगा विंध्य हिमाचल यमुना गंगा उच्छल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाहे तव जय गादा जनगण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे
Thank you and have a grateful evening.
Feedback for